There are 5 main criteria that affects your credit score. The first one is your payment history, which accounts 45% of your score. Now, this refers to your past payment behavior on your credit or loan with the banks. Also, if you have any debt settlements, bankruptcies, foreclosures, or legal suits against you. Now, these are some of the worst things to have on your credit report from a bank's perspective. Number 2 is the amount of debt that you owe, which accounts for 20% of your credit score. Now, how much of your total available credit have you used? Less is better, but owing a little bit can be better than owing nothing at all, because banks want to see that if you borrow money, you're financially stable enough to pay it back. Now, number 3 is the length of credit history, which accounts for 7% of your credit score. Now, how long have you been using your credit, and what is the average age of all your accounts? A long history can be helpful if it doesn't show late payments, but a short history can be fine too, as long as you have a good payment record. Now, number 4 is your credit mix. Now, this accounts for 14% of your credit score. This look into a mix of different types of credit, such as credit cards and your mortgage. Having a good credit mix can show more references and increase your credit score. Now, last but not least, new credit type. This accounts for the last 14% of your credit score. This means the new accounts that you have applied for recently. Now, if you have opened several new accounts recently, the assumption is that you could be at a greater credit risk, as people tend to open new accounts when they are experiencing cash flow problems or planning to take on lots of new debt. If you want to get a better approval and interest rate, make sure you check above with credit reporting agencies like 𝐶𝐶𝑡OS and find out your profile.